Okay, I'm back, traders. Ever wondered how the pros break down the gold market before they strike? In this video, I'm diving deep into XAUUSD with real-time technical analysis, no fluff, just pure price action. From key zones to sniper entries, you're about to see the exact mindset and moves behind a live trade. If you're serious about leveling up your trading game, stay locked in. This is where gold gets decoded. Let's go. All right, so we're going to start off with a quick top-down analysis, and the purpose of this is to recognize recurring patterns, build rhythm, and be in tune with the market. All right. So currently we are on the monthly time frame of gold, and we can clearly see that the chart has been pretty bullish for quite a long time now. All right. But particularly, we want to be focused on the current monthly candle, which is right here. Okay, let's first take that off. And what do we see? It's pretty bullish. Okay, but what do we see? It has a long wick at the bottom and a short wick at the top, meaning uh, first this candle was bearish, so meaning sellers pushed the price down, but then bullish guys came in and pushed the prices back up to where they are right now. Okay, now here the intention of this is to frame the true direction of bias of this pair. And to do this, I like to use a set of three timeframes, which I like to call the big three timeframes, right? In order to get the true trend and the true direction of bias of the market, which is the monthly, weekly, and the daily. I like to call these the big three. So with that in mind, let's go down to the weekly time frame. Now on the weekly time frame, we want to focus on the current candle that just closed of the week, which is this one right here. And also, what do we see? We see that it first opened and first traded lower. Then after that, price was then pushed up by the strong bulls in this market, and eventually broke the previous weekly high right here. And actually, we have now closed with a wick to body break of structure, which is usually a strong confirmation for the direction that the candle has closed in. And this time we are closing bullish. So usually by looking at the weekly candle, this can help us to frame the image of the next week, right? How the next week is going to go, how the next weekly candle is going to look like. And usually there is a trick that I like to use, right? So this is something that I picked up, and I realized that after a kink or after price does this, after the weekly candle, for example, engulfs this counter candle, right? Usually the next candle that comes after it is usually identical to the candle that engulfs, right? And this time even just by looking at this one here, though this wasn't a perfect example, but just looking at price lower, we can see this phenomenon happening, this pattern repeating itself over and over and over and over again. And actually, it doesn't stop here. It goes on and on, as you can see, even here, even down here, right? Engulf. The next two or three candles that get formed are usually identical to the candle that engulfs. Okay, engulfing the next two or three candles that get formed, Actually, it also works in a seller's market. When the sentiment is also bearish. It's not just that since it's a bullish market, it's only working on bullish trends. It also works on in times when we're bearish as well. So as you can see, almost this was almost a sharp kink, and price did that down here. So the purpose of this is to recognize patterns that have been happening over and over and over and over again, so that we can get uh, an idea. See that? An idea. See this? Of what to look for the next week. So since it's the weekend, this is just simple pre-market analysis to just make a review and get ready for the next price movements that are going to happen in the new week. So what? So since now we expect that the new market, the new weekly candle is going to be bullish. What should we look for? So anyway, we still have to assess the daily time frame, and on it we can already see. Let me take these off. We can already see that first on the daily time frame, sellers actually sellers actually had the buyers running for their money here, right? They first pushed seriously the price down and even broke this low, right? With an actual wick to body break structure, meaning they really came to eat. And actually as they did this, they largely disrespected most of the bullish order blocks that were resting down here. If I told you to scale down to lower time frames, but then something happened, and the bulls on was it on Thursday, they came in, and they first showed signs to the sellers first showed signs to to sell, but the bulls eventually came in and they overpowered the sellers, and they flipped the script on them, and they pushed prices above here, and we had a new wick to body break of structure, meaning we have here we have a higher time frame flip, right? This is a higher time frame flip. So usually you could if at all this such a pattern, if at all it happens on a lower time frame, usually uh, you can come in for a retracement move, and you catch prices. It comes back to test this level right here. But now when it comes to framing of trades, I like to break down the time frames following following something that I call time frame coordination. So I have two sets. One one is one that starts with the monthly time frame, following the daily time frame, the hourly time frame, and the 15-minute with the 5-minute, and finally the 1-minute time frame. This is just one set, okay? Time frame coordination. So we can frame the trades and later on we execute, okay? This is one. The second one is one that starts with the weekly time frame, followed by the 4-hour, then the 30-minute time frame, 5-minute, and finally the 1-minute time frame. So usually, if at all I don't find my setup on the monthly set, I go down to the weekly set. I like following the monthly set. Why? Because usually, when I look at the monthly candle, I already said, I hope I said it. The monthly candle usually is the one that dictates the trading environment on the lower time frames. Actually, the big three time frames are the ones that actually determine and dictate the trading environment on the lower time frames. So in the event that we're intraday trading, most of the time we want after we have established the true trend of the market, we then go down to the weekly and daily time frame, to be now able to focus and frame our trades accurately, on the chart. So I like scaling out to the, so after a move, a huge move like this, my system tells me to focus on the area of liquidity that recently broke market structure. Though by looking at the behavior, so 4 hour to weekly, say 4 hour to weekly, but then looking at the behavior of the market, usually after a break like this, most of the time price doesn't retrace to such low levels, right? As you can see, but it's just something that you just that is just nice to have, to know. Sorry, to know at the back. Just keep it at the back of your mind, so that in the event that okay, price still comes back and retraces to a zone like this, you are not caught off guard, right? You still know what you are doing or what you're looking for anyway. Okay, so anyway, what do we expect after all this analysis? We expect that the next week is going to be bullish, meaning what? The next daily candle that is going to probably get formed. Well, anyway, let's do it like this. Looking at anyway the price action anyway. We from the analysis that we have made, we expect that the next weekly candle is also going to what? To be bullish. Okay, that's one. And what kind of behavior do we now expect to see on the daily time frame? The daily time frame, since we expect the new week to be uh, bullish, we expect that probably the next week is going to probably open, and the new daily candle is going to first probably retrace. So the a retracement is expected, but eventually we expect that price will then break above the weekly open level, and from that level we expect bullish days after that, and probably push prices even higher. In the event that price doesn't come back to such a level, well, there's a possibility that it can, there's a possibility that it won't, right? All that we have to wait for are areas where price fails to engineer liquidity, or we look, or you can call them failed flip zones. Usually, these are areas that I enter in at. And now, and where do I spot them? I spot them on the lower time frames. And for gold, the execution time frames for me are the 5 minute and the 1 minute time frame. And this is what I tend to look for. An area where, let's say, now for this case, since I'm bullish, I expect to see a zone. Oh, this is too big. Anyway, I expect to see a zone where price fails to shift to the downside. So anyway, an example of a flip level here is, for example, here, as you can see, price failed to continue the breakdown here. After that, price came and retraced and tapped in that level right there. So such levels here are usually levels that price creates, and we get these continuational trends with huge momentum. The reason why I like executing off of the 5 minute time frame over let's say the 30 minute or 1 hour time frame, simply because the moves on the 5 minute time frame, for example. Now here we're now uh, framing, we're framing our trades. Okay, just by reviewing the previous price action, right? We can see that just on average, one 15-minute candle can move 50, sometimes 100 and 110 pips. And actually even in the 5 minute time frame, we have candles that can go for 100 pips. Yeah, so for 90, 100 pips. So a confirmation criteria that I find on a 5 minute time frame is usually strong enough for me to consider. Even for example, even down here, there was another flip zone. So now for example, now these are the zones that I like to look out for forming in the market. And usually they give you little drawdown, and you can easily catch the next big move. You don't need to get in right away, when the market opens. You can just wait it out, because usually actually on Monday, now the expectation on Monday is price is probably going to gap down. Now after the gap down, that will be one of the things that will confirm that we are, first of all, what, we're bullish. After the gap down, usually price closes the area partially or sometimes fully. Then you could expect a retracement. Now with that retracement, you want to look out for patterns like this on the lower time frame. You want to look out for patterns like this. Price points where price showed that it probably wanted to do something, but it did something else. So as you can see even here, such a though price might not react, might not come back to these areas, but it, but price tends to create new ones, you could say. So what I want to so in order to get uh, into buy positions, I want to look for I want to see flip levels on the 5 minute and probably the 15-minute time frame. So if at all the area for me is huge on the 15-minute time frame, I like to scale down to the 5 minute time frame. And with that, I'm using the time frame coordination of daily. I'm using the set of monthly, daily, hourly, 15 minute and 5 minute. So I look for flip levels. And what are flip levels? For those that are asking, flip levels are areas in the market where price delivery changes. Other people can call them areas where uh, a resistance turns to a support level, or an area of a failed shift, or a failed Quasimodo pattern, right? So that's basically it. And usually I like to have the stop loss usually not beyond uh, not beyond 30 pips for me. And as you can see, it's usually friendly when you pick them from these lower time frames, more so the 5 minute time frame. 5 minute, to me, 5 minute confirmation is good enough, because of the distance that the price moves. Price tends to move really, really, uh, really well, and it gives us real serious distances on the chart, as you can see right here. So as you can see, even just one candle here on the 5 minute time frame is almost what, coming to 100, whatever, 100 pips. So this is already 60 pips, just one 5 minute candle, right? So to me, this is good enough, and I can go by this. And actually now this is what I I am looking forward to see in the next week, uh, how I'm going to frame, how I'm going to look for target points. For target points, you can simply use psychological levels. Psychological levels are usually those, to put it simply, are usually those round price points. So, for example, right now we are dealing in the range of 320 of 3,000 and 200. The next round number is 3,300. So right here, as you can see, it's almost there. It was almost there. Let's see. Let's see. Right there. Right now, this is a new area. Okay. We can see it. We can use this in the hourly, sorry, in the monthly candle, sorry, a monthly chart to see like how the next candle is going to be. So just by assessing the weekly candle, we can see that the previous candle moved it moved around 2000 pips. So we can estimate and assume that the next candle will move either half or exactly or more than this candle. So a healthy target could be like, half. So you could say that it could move 1,000 pips. Now, in within this 1,000 pip range, there is a lot of opportunity. One, you could get in at one price area and you just swing this. You can just swing price to this price point, or two, you can just pick maybe only half of the 1,000 pips, or 10,000 points. So you go with 5,000 points, right? Instead of the full 10,000. But usually anyway, the next candle that comes after usually is either half or slight, or even more than the next candle that gets formed. So that's just something to have in mind as we frame our trades on the lower time frames. So if at all you're not a swing kind of person, you can just target the next round figure from here. Oh, and there's something that I realized. Just I think I wrote it down here. Yeah, just 3,100 to 3,200 is 1,000 pips on gold, or 10,000 points, right? So there's a lot of opportunity on this pair, as you can see, and you can just wake up, dip your face in ice water, and make at least $10,000. Okay. Then what am I missing? Oh, there is something that I wanted to show you guys. A way to quickly calculate your pips. Sorry, most of the time people like to get apps to help them calculate their lot size to use on their account. Now we're talking about, so we have gone from the top down analysis, the establishment of the true trend, the trade frame, or the framing of the trade, and now we're going to execution. So execution, the first part of the execution is to now know is now uh, from knowing the entry point to the target. The next thing that you need to know is the execution, the actual execution, the art of execution. And to do that, we need to understand the account size that we have, and two, the lot size that we're going to use, because that, at the end of the day, is what determines how much money you're making in the market. And Okay, I've written it down here. So it's something that I already wrote down, so I'm just going to, okay, it's down here, trade execution. So we already went through all of this. We've already established that the true trend is bullish. The new week, we should look for bullish setups. Either you refine a previously created level or focus on the current weekly candle movement in relation with the daily candles. And as price moves above the weekly open, you can scale down to lower time frames. Ideally, the 15-minute time frame and the 5-minute time frame. You look for shifts or change of character confirmations to now the upside, or maybe flip levels. And why? Uh, why? Because anyway, usually these 5-minute confirmations and 15-minute confirmations are good enough. Why? Because just even one kind of the 5-minute time frame is about 100 pips, give or take. 50, 70, 100 pips. So it's good enough. The movement is real good. So to get the range and targets, we use psychological levels based around the about around round numbers. Since we are now above the price point of 3,000, we are looking at these numbers: 3,100, 200. So right now we're at 3,200. We're expected to go to 3,300, and maybe probably after that 400 and 500. Okay, and already just from 3,100 to 200, it's 1,000 points. So same thing from 3,200 to 3,300 is 10,000 points or 1,000 pips again. And there is a lot of opportunity. You could either, it doesn't matter if you catch the whole move. All you need is really a piece of it, because really, as long as you have used a an appropriate lot size, you're usually going to get what you're looking for. All right. So anyway, the equation that I wanted to show you guys is, I'll just write it down again. So usually it goes like this. First of all, the first thing that you need to have in mind is that 1 pip is usually equal to 10 points. Okay. So how does this work in our equation? In our equation, the equation that I have for you is, get the number of lot size or sizes that you're using, multiplied by the number of points moved by the market. And usually, most of the time, this will give you your dollar value in the market. Sorry, dollar value. Okay, so basically, you could just say total position size. So for people who are using multiple loads, you can get the whole number of those lots that you're using, and you multiply them with the number of points moved the market, and usually most of the time that will give you your dollar value. For example, if at all I'm using a lot size of 0.1, right? Lot size of 0.1, I'm going to multiply that by maybe, let's say the market moved by 100 pips. Okay, so 100 pips, those 100 pips, I'm going to first multiply those 100 pips by 10 so that I can get the points. And usually this, now this becomes what? That becomes already 10,000 points. And this will most of the time equal to, and most of the time it actually equals to $100. That's what you're gonna be making. So this formula works on literally anything. So and it's actually quite simple. You don't need a lot size calculator. It reaches a point where you're doing this math in your head. So it's simple math, and it's literally straightforward. If at all you need to find the number of pips that you're going to have to to look for in the market, given the fact that you want to risk, let's say you want to risk only $20. Yeah, you can use this formula here. You want to risk $20 in the market. You can use this this formula right here, and you 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 assess the distance, that trade is framed around, and you simply get that dollar value divided by the number of points, and you'll get the actual lot size that you need. I'll just write it down. So if at all you're looking for the lot size, you'll get, sorry about that, you'll get the dollar value divided by the number of points. I'll just write points. So it's simple as that. And it comes from the universal equation, which is the lot size multiplied by the points, and that will give you your dollar value. And just like that, you've made $10,000. So in the event that you need to make $10,000, and probably you're only looking for a 100 pip movement, you're going to now have to switch your lot size from 0.1 to, let's say, 1. You're going to use lot size 1, uh, and you're going to risk, you're going to risk in an area of only 100 pips. And the no, you're going to use lot size 100 pips. You're going to use lot size 10. Yeah, you're gonna have to use lot size 10 to make to get to $10,000. If it's $1,000, that's where you use lot size 1 in an area of 100 pips. 100 pips is actually down here, really. Anyway, you get the idea. You just round off to the, yeah, because we're in the weekly chart, so it's actually down here. You move this decimal point down to this point. So we're in the weekly chart, so it looks small. It looks really small, but it's actually huge. This is actually what it is. This is what 100 pips looks like on gold. Okay, so with that all said and done, I hope you've got some value from this video. If at all you're looking for a community to join to support you as an intermediate or probably seasoned trader on your way to mastery, you can join my free Telegram group. It's I have the link down in the description down below, and it's for new traders. I'm gonna be posting some trade related content, and it will be quite helpful, really. I'm also going to drop a short document about lot sizes and all of that. So it's a risk management cheat sheet, and it also has this equation right here. If at all you don't have Telegram, you can download it, or you can leave your email down below in the comment section. I reply to every comment, so I will email you the cheat sheet, the risk management cheat sheet. Okay, I think that's it for now, and we'll see now how the next week goes.